All right, let's dive right into this explainer. If you're getting close to retirement, you might think the very next step is simple. Just start withdrawing from your 401k. But hold on a second. Before you do that, we're going to compare two very different paths today. We'll look at what a traditional 25-year withdrawal plan could pay versus what a fixed indexed annuity, or FIA, income strategy may be able to create. And honestly, the difference in how these strategies work might absolutely surprise you.
So a lot of really successful savers make a universally held but kind of flawed assumption when they reach retirement. They tell themselves, well, I spent decades saving this money, so now I just start withdrawing from it. I mean, it sounds perfectly logical, right? But here's the problem. Simply withdrawing from a retirement account is not the same thing as building a sustainable retirement paycheck.
The absolutely crucial point here is that a 401k was built primarily as an accumulation account. It's expertly designed to help gather and grow your money during your working years. But once retirement begins, the whole game changes. Your 401k balance just doesn't automatically convert into a pension-like paycheck. The new question you actually have to ask yourself is, how much dependable monthly income can this account realistically create, and how long will that income last?
Okay, let's look at Path A, the traditional withdrawal plan. Let's see how this builds using a standard 401k growth and withdrawal calculator. Imagine a hypothetical 55-year-old who currently has $250,000 saved up, and they've got a 10-year period leading into their retirement at age 65. During those final 10 working years, we're going to assume this person makes a $1,200 annual contribution to their account. If we use a 5% assumed investment return rate, the projected balance by the time they reach retirement at 65 grows to $423,071.80. Now that gives our retiree a really solid account balance. But remember, a balance still doesn't automatically equal a paycheck. So let's convert that balance into an income stream using a standard withdrawal calculator. If we withdraw from that $423,071.80 balance over a 25-year period, so from age 65 to age 90, with an ongoing 5% assumed return during retirement, the calculator gives us an annual pre-tax payout of $28,588.56.
But, of course, Uncle Sam wants his cut. Traditional 401k withdrawals are generally taxable as ordinary income. They don't just go straight into your pocket. So, factoring in a 15% income tax rate, we lose $4,288.28 to taxes each and every year.
And this brilliantly illustrates our baseline. Under these exact calculator assumptions, a pure withdrawal strategy produces an annual post-tax amount of about $24,300. That breaks down to roughly $2,025 per month after taxes over 25 years. But keep in mind, this income relies on incredibly strict assumptions. It requires exactly a 5% return every single year. It assumes you only need the money for exactly 25 years, and it literally involves watching your account balance steadily decline all the way to zero.
Which brings us to Section 2, the hidden risks of withdrawals.
What's really fascinating about this traditional path is the real-world hidden limitations. A calculator gives you a beautifully structured payout estimate on a nice clean spreadsheet, but it completely glosses over 5 major risks. And it doesn't provide guaranteed lifetime income. First, there's market risk. Your account constantly fluctuates with the stock market. Second is sequence of returns risk. If the market crashes early in your retirement while you're taking withdrawals, your account is severely damaged. Third is longevity risk. What if you live to be 92, but your plan only lasted 25 years? Fourth is tax risk. And finally, there's emotional risk. Watching your life savings shrink down to zero can create immense, heavy stress in retirement, basically making people too afraid to actually spend and enjoy their hard-earned money.
So let's pivot to Path B, the FIA income strategy. Let's shift our paradigm entirely. What if we reposition that money into an insurance-based fixed indexed annuity, or FIA? This prioritizes protection and structure. Unlike a purely investment-based account, an FIA is designed specifically for accumulation and withdrawals under specific contract terms. Using an official illustration for an American Equity Asset Shield 10 FIA, we're going to use the exact same starting numbers, a $250,000 initial premium at age 55 and $1,200 in additional annual premiums over the next 10 years. Total premiums shown are approximately $262,000. Let's see how this strategy may potentially structure the money completely differently for our hypothetical retiree. In this specific illustration, looking at the non-guaranteed projection, the contract value at age 65, which is the end of year 10, reaches $435,540. This design shows protection from direct stock market losses while offering index-linked crediting potential to help the money grow safely prior to actually turning on that income.
And here is where it builds remarkably.
Starting with a first illustrated withdrawal around age 65 of $30,488, the total non-guaranteed withdrawals shown over the lifetime reach an incredible $664,189. Now, it is incredibly important to note that these are non-guaranteed projections based on index performance. But to provide full context and transparency, the guaranteed total withdrawals shown on this exact same illustration are $222,280.
But what's truly fascinating is what happens to the underlying account balance. Even after taking decades of those non-guaranteed withdrawals, this illustration shows a remaining non-guaranteed contract value and death benefit of $292,961 still remaining around age 90. That contrasts sharply with the traditional 401k calculator approach we looked at earlier, which completely depleted the account to zero.
So, let's put it all together in Section 4, comparing the two approaches. Our goal today isn't to say that one strategy is definitively right for everyone. It's to understand why comparing your options is so absolutely vital before you make an irreversible retirement decision. Let's put these two mathematical paths side by side. The biggest difference between the two strategies isn't just the numbers, it's the core design. A withdrawal plan simply asks, how much can I take out without running out too soon? It's a spend-down strategy. Meanwhile, an FIA income strategy asks, how can this money be structured to potentially create a more predictable, protected, pension-like income stream?
Now we have to talk about Section 5, the trade-offs.
Of course, it is essential to understand that an FIA is not right for everyone. Every single financial product comes with specific trade-offs, and it's crucial we put those on the table to give you a clear, unbiased picture. Unlike a standard brokerage account, an annuity may have surrender charges and liquidity limitations, meaning you can't just cash out the entire account on day one without penalties. They may have fees or rider costs, and the growth is subject to caps and participation rates. Plus, its guarantees rely entirely on the claims-paying ability of the issuing insurance company, meaning non-guaranteed values could be higher or lower depending on the actual contract terms and index performance.
So, the absolute biggest lesson to take away from this explainer is that spending down an account and creating a structured income plan are simply not the same thing. The question isn't just how much you saved during your working years. The real question is how much dependable income your assets can safely create for you. The mistake isn't withdrawing, the mistake is withdrawing without comparing your options first.
Now, before we wrap up, I do need to remind you, this explainer is for educational purposes only and is not personal financial, tax, legal, investment, or insurance advice. The FIA values shown are based on an illustration and are not intended to predict actual performance. Non-guaranteed values may be higher or lower than shown. Guarantees are backed by the claims-paying ability of the issuing insurance company. Annuities may have surrender charges, liquidity limitations, fees, caps, participation rates, tax consequences, and other restrictions.
If you want to see how your own 401k, IRA, or retirement savings could potentially work as a structured monthly income strategy, don't just guess. Use our free retirement income planner or schedule a personalized retirement income review today. Make sure your hard-earned savings are doing the best possible job for you in retirement. Ultimately, it really comes down to this. Are you prepared to risk outliving your money, or are you ready to build a strategy designed to outlive you?